The RBI conducted 50,000 crore of variable rate reverse repo. What does this mean? Variable rate reverse repo is a type of reverse repo. Let's try and first understand what a repo is. A repo is nothing but a repurchase option. In simplest of terms, what it means is it's a rate at which banks, scheduled commercial banks, your HDFC Bank, your SBI, borrows money from the Reserve Bank of India. So when the repo is at 4%, the banks, which is an SBI, will borrow at 4% from the RBI and then lend the same amount of money to you at say a 6.5 or a 7%, which is your typical home loan rates. But the one important piece of this is the repo is only a short-term agreement. It's only a short-term rate. So it's not a rate for a very long tenure of time. So technically speaking, if the RBI hikes the repo from 4 to 6.5, which it has since May of 2022 till now, it's hiked the repo from 4% to 6.5%. It essentially means that banks are now borrowing money at the rate of 6.5%. What does this do? It essentially takes loan rates in the hands of the consumers higher. When loan rates were at 6.5%, 7%, the home loan rate, at that time, it encourages you, the consumer, to buy more homes, right? And when it goes up to 9.5%, 10%, it makes it less sensible, less lucrative for the consumer, that is you, to buy homes on loan, which therefore reduces consumption. So what this also does, what the repo actually controls is two things. One is demand in the system, and therefore it also controls growth, right? But what does the repo in consequence mean? It means that consumers have more buying power. It means that you as the consumer will buy more when the repo is low at 4%, which means that there's more money flushed into the system, which means essentially that inflation will start to go up. So the RBI has to balance both growth and inflation, and it does so using one of its instruments called the repo. Now let's try and understand what the reverse repo therefore is. The reverse repo is nothing but the repo from an RBI standpoint. I'll try and break this down further. So when a company, a bank, an SBI enters into a repo agreement with the RBI, the RBI has essentially entered into a reverse repo agreement with the bank. So now a reverse repo from a bank standpoint is when bank parks funds with the RBI, what's the rate of return which the RBI gives to the bank, and that essentially is the reverse repo. Now, what does all of this mean? Technically speaking, the reverse repo and the repo also govern the Indian 10-year bond yield, which is the other component which the RBI likes to control. So what the RBI therefore does is it has a shorter tenure of products which control the amount of debt cost within the system. And the VRRR essentially takes care of the shorter tenured loans which are supposed to be given out. And what the VRRR therefore does is it allows banks to park funds with the RBI at a particular rate of interest. And the RBI auctions the VRRRs on the basis of the rate of interest availed by or the quote submitted by the banks. The VRRR currently conducted on the 24th of February was worth 50,000 crore.
If you like this video, then like, share and subscribe to ET Now.